Okay, so in this, sorry about that. All right, here's my screen. I hope you can see it. So this is chapter 11, and chapter 11 goes over corporate reporting and analysis. So far, I mean, you guys are super familiar with assets and liabilities. I hope you are. What we're going to talk about today, I'm going to start here at slide 8 because you need to understand, before we get to Treasury stock and really for Janelle's benefit, you need to understand what those stock transactions are. So whenever the company issues stock certificates, remember how in the previous chapter we talked about bonds, and we talked about bonds as a form of financing, right? This is another form of financing. So if the previous chapter we talked about debt financing, this is what we call equity financing. So the company issues stock and then they get cash in return. So there's some basic things that you need to understand before we get to Treasury stock. And then Wednesday, if you guys are interested, we'll work some problems. But again, here the terminology is a little overwhelming. So anyway, when the company decides to issue stock, they essentially decide to go public, and they have to determine how many stock certificates in total do they want to sell. So we call those authorized shares. So this here, the word authorized means the total number of shares they want to issue. That number, though, is not the same as the stock shares issued and outstanding. So you should see like this here, it says authorized 250 million shares, but the company only issued 92,000 plus, 92 million plus shares. So the number of authorized shares and the number of shares issued and outstanding differs most of the time. So these are shares that the company issues to obtain capital. And this is the first basic thing that I wanted to understand. Sometimes the numbers issued and the numbers outstanding will differ because of what Dave brought up, Treasury stock. So the company may buy back some of their stock certificates. They may reissue those later. So all of these numbers may be quite different. So here's something that you guys need to know, that just like bonds, the stock certificates have a par value. So that is what the company assigns to each share of stock. And for the most part, you're going to see they issued stock with a par value of $1 or $10. So the company just arbitrarily assigns a number to each share of stock just to give them some kind of a baseline for comparison. The par value is usually much lower than the market price. The market price is what the company will end up getting for their stock certificates. So here is another important thing. The company will only get cash at the initial public offering. So once they sell those shares of stock and they become the ownership of those shares is transferred to the stockholders, the company will never get any more cash for those shares unless Dave, along those lines of your question, unless the company buys Treasury stock and then resells it, whether it's for over or under par value, still the company will be getting some cash. So this is very important to remember. Par value is just an arbitrary number, and it's kind of a low number. So let's say you have a stock with a par value of $10, but the market price, the investors decide to buy your stock for $30. The difference between the two is what we call paid-in capital. So when the company issues stock, so this is slide 13, when the company issues stock, and let's say the stock has a par value of $10, like it is on this slide. They start selling the stock, and the investors give the company exactly $10. We say that this stock is issued at par value. And remember, this is works exactly the same, just like the bonds that we talked about last time. If the market price is higher than the par value, then the stock is issued at a premium. And this is, again, Dave, something to keep in mind. Cash will be higher this time because the stock is at a premium. But unlike bonds, where we had another account, here we place these all of these accounts are stockholders equity accounts. So inside stockholders equity, we'll be reporting the paid-in capital in excess of par. Some books and really in the industry, this is called additional paid-in capital, or APIC. So this difference will remain a part of stockholders equity, and we will not be amortizing this like we did in the previous chapter. So the reason why I'm bringing this up is because you need to understand that in the stockholders equity section of the balance sheet, we'll always report common stock at par, just like here. See, they issued 50,000. What is it? They issued 30,000 shares, so common stock is 300,000. But if they have paid-in capital in excess of par, we know that the company did not receive $10 per share in cash. They received more. How much more? They received $60,000 in total. If you divide that by the 30,000 shares, you'll see that the company received $2 extra. So this is important. Again, the stockholders' equity will contain information about common stock at par, and then everything else the company received in addition to the par value of the stock will be reported in the paid-in capital in excess of par. So sometimes, and these are really not very important cases, just so you know. Sometimes the company will issue no par, and if they issue no par stock, then whatever the proceeds from the sale are, that's what would be credited to common stock and remain in the stockholders' equity. The company can also issue stock with stated value. The stated value will be specifically stated. This is 40 stated value stock. They issue that for $50 per share. So the stated value will become part of the common stock entry, and then the rest will go into additional paid-in capital of excess, in excess of stated value, common stock. So these are just different ways to issue common stock. Remember, the common stock could be issued at par, it could be premium, or it could be stated or no par stock. One thing that you're probably already noticing, there's no such a thing as stock issued at a discount. So what that would mean is that the company will get less than what they're reporting, which would decrease stockholders' equity. I'm sorry, less than what they're asking in terms of par, which will decrease their stockholders' equity, and that is simply not allowed. Very few times the investors will be willing to go under par. Okay, let's look at dividends.
I don't know that.
So dividends are the cash outflows that the company has to spend to pay their stockholders. There are two conditions that the company has to meet to pay dividends. So they have to have a sufficient balance in their retained earnings. So they have to be profitable, right? Remember, retained earnings is nothing but the net income that the company generates during the particular period. And then they need to have the cash to pay the dividend. And I think it's very interesting because there's some companies out there, including Microsoft, that were very profitable. They also had cash to pay dividends, but they never paid dividends. Microsoft, I think the first time they paid dividends was about 10 years ago. And the reason why they kept their cash, even though they were profitable and they could be paying dividends, they kept their cash just so they can grow, they can expand. Look at Microsoft. Anyway, so I'm so sorry about these emails coming through. So anyway, whenever the company decides to pay cash, they have to declare the dividend. So whenever dividend is declared, we need to record a liability. We call that liability dividends payable. And then whenever the company actually pays dividends, we have to record the cash payment. So this is pretty straightforward. On the date of declaration, the company will show here on the bottom, they'll show the credit to liabilities, and then the debt of retained earnings. And then at the time of payment, the liability will go away, and then cash will decrease as well. There are a couple of different types of stock, right? There's common stock and preferred stock. So the dividends work a little bit different for those two types of stock. So one of the things that I was going to tell you, you will not be responsible for stock dividends or small stock or large stock dividend. You will, however, be or stocks or stock splits. What you will be responsible for starts on slide 33. Earlier I said that there is two different types of shares, right? One is the common stock. The second one is the preferred stock. So preferred stock, as the name suggests, preferred stockholders, they're usually paid dividend before the stockholders are concerned. So the dividend distributions will be offered to preferred stockholders first, and then common stock holders will receive their dividend. Another important difference between preferred and common stock is common stockholders, they're the ones who have voting rights, but preferred stockholders don't. So usually stockholders who, hold on just a second, let me look at the question. Okay, Dave. To receive, yes, so to be able to get those advantages, the preferred stockholders, those are usually more expensive shares, right? And you'll see that if the common stock has a par value of $10, then the preferred stock would probably have a value of $100, something like that. And those preferred stockholders, they're more interested in getting their guaranteed dividends. They're not as interested in having voting rights and, electing the board of the directors, etc. So yes, to receive these advantages, they pay more. The preferred shares are more expensive. So look at this here. Even though these are examples from the book, right? These numbers are made up. When we issue preferred stock, look at how much more expensive it is. The preferred stock has 100% par value. Now, if the preferred stock is cumulative, let's say the company didn't pay dividends last year, but the preferred stock is cumulative this year. If they declare dividends, the preferred stockholders will be paid first for last year, then for this year. So all the dividends in arrears will be paid all the dividends they owe for the current period will be paid before any common stock dividends are paid. So yes, in order to for preferred stockholders to benefit, they have to pay more, but they're also guaranteed a dividend, and that dividend is usually is expressed as a percentage of that par value. So in this case, so here's an example here. They declared and paid cash dividends of $42,000. See how, and you can barely see it, but right here where it's preferred, they will pay the preferred stockholders first, followed by the common stockholders. I mean, hey, rich people always have advantages, but let me just talk about this a little bit. I don't believe there are any ethical violations with preferred stock, because when you really think about it, Dave, when you really think about it, think about banks. Oh no, this is a good discussion. I'm enjoying this. So Dave, think about banks, right? Are there any ethical violations whenever they extend a loan and charge 25, 30, 150, 3,000% sometimes? So stockholders, whether they're preferred or common, they don't get paid anything. Let's say the company goes bankrupt, right? So if the company has debt, any kind of obligations, those creditors will get paid first if a company is liquidated, and only then the preferred and the common stockholders will get paid if there is anything left. So it seems like, banks have an unfair advantage also. Does that help? But as far as I know, there's no ethical violations. If you have the money to afford to buy a preferred stock, you do. So I hope this answers your question, or maybe gives you, yeah, that's exactly right. Okay, so let's talk about, we are gonna go to Treasury stock. So Treasury stock is actually interesting, because remember, the company authorizes a bunch of shares, and then they issue a different number of shares, which is usually less. So at some point, the company may decide to buy back their own stock. And the reason why they may do that is because, one of the most common reasons is to use their stock as incentive compensation. So they buy back as treasury stock, and then they reissue it to employees as part of their incentive compensation. And here the theory is that if the employee owns a stock certificate or 2 or 5 or 100 in the company, they'll work even harder to make the company successful. Some other reasons, let's say the company's shares are trading at lower prices than the company wants, then they may buy them back to encourage a price increase, or to maintain a strong market. There are a couple of other reasons. The company may be buying back their shares to avoid somebody else buying the company. We call that a hostile takeover. Or they may be buying their shares back as treasury stock to use those shares to buy other companies. So there are several different reasons why the companies would do that. Most companies have treasury stock, as you can see below. About 62% of all companies have treasury stock. So at some point they have bought their stock back. All right, so now we're slowly inching towards Dave's initial question. When the company buys treasury stock, I want you to notice here that they have to pay the market price, whatever their stock is trading at that point in time, or whatever the market price is, that's what the company will be bringing the treasury stock at. So this is the first step. We can't answer Dave's question unless, there is treasury stock. We can't have treasury stock unless the company buys it back. So treasury stock, because remember, if the company buys back their stock, they're losing stockholders. Stockholders' equity will be going down. Treasury stock is debited. Treasury stock is not credited like common stock. So obviously, if we are if we're selling treasury stock at cost, if the company repurchased it at the market price and then they decide to issue it again at that same price, then obviously we don't have an issue. Cash will go up and then we'll credit treasury stock common. So I'm going to go back to the previous slide. They're buying $11,500 worth of treasury stock. They're issuing $1,150. So the difference is what remains in the treasury stock account. Now, look at this situation. If they bought it at $11.50, but they're selling it at $12, then this is exactly what we went over when it came to common stock. The company will be getting more cash, so cash will be going up. The difference between the repurchase price, in this case $11.50, and the selling price of $12 will go into the additional paid-in capital or paid-in capital in excess of that market price treasury stock. And now we are going to answer Dave's question, I hope. Remember, this is still the same example. When the company purchased their treasury stock, they purchased it at $11.50 per share. This is a situation where maybe the company needs cash, and this is a quick way to sell some stock and turn it into cash, and they're willing to take less than what they bought the treasury stock for. So the first thing we need to look at is how much are they selling it for? They're selling it for $10 per share. We know that they're selling it below cost because the original price of those treasury stocks was $11.50. So the difference between $10 and the $11.50, that difference of $1.50 will be reducing stockholders' equity. And that's the reason why the difference will go into the paid-in capital treasury stock with a debit. The company will still get cash for the shares. However, this will be a reduction to stockholders' equity to account for the fact that they are selling treasury stock at less than what they paid for. So Dave, ask me your question. So what is it that you're confused with here? All right. So if there was no previous, let me go back to the slides. So see how the paid-in capital has to be split. So earlier we said, oh, the company issues common stock, paid-in capital, common stock is credited. Does that make sense? Okay, so now that we're dealing with treasury stock, we will be using paid-in capital treasury stock to account for those transactions. So first, note that if there is no paid-in capital at this point, when the treasury stock is sold, right? Then we'll just debit paid-in capital if it's below cost, and that would be the first entry to paid-in capital. Essentially, really everything goes in stockholders' equity. It would not go in retained earnings. The only thing that goes into retained earnings is net income, which is the performance, right? The profit that the company realized, if there was profit, or the loss if there was loss plus dividends. So remember from way back when at the beginning of the semester, the company has many accounts to use. So if there was no previous paid-in capital, you won't even see a paid-in capital account. But whenever the company starts debiting or crediting paid-in capital, they'll just pick that account and debit and credit to it accordingly. Retained earnings, you will only see net income and dividends, whatever that net income is, profit or loss. Does that help? So here's a blurb on statement of retained earnings. So this is the cumulative amount of net income less dividends. And the statement of retained earnings just shows that. On the statement of retained earnings, we can also have some prior period adjustments. Those prior period adjustments really will be on the income statement, and they'll show up on the statement of retained earnings as well. So I will be, should you guys choose to come back on Wednesday, I'll be working problems from this chapter. I usually don't really jump into problems day one because I want you to look at the terminology and kind of understand what I'm talking about. So on Wednesday, we'll be working problems from this chapter. Did I answer your question, Dave, or do we need to talk about that treasury stock transaction again? So if I did, that's really it for today. And if I didn't,